All right, here we go. So, Friday and Monday, stocks sold off. Yesterday, recovering a little bit, and today, recovering some more. So, is the worst over? Well, the fear index, the VIX, is also lower again. So, it seems that we are kind of back to normal. And with that, the focus is on earnings again. So, we'll talk about several earnings today. We'll talk about our positions and everything else that's going on in the markets. And with that said, welcome to Coffee with Markus and Mark. And today is Wednesday, August 7th. And in this show, we are going to talk to you about what's happening in the markets and how we are trading it. And Mark, it definitely seems like recovery mode activated. I mean, today, everything in the green again.
Yeah, I mean, this is nice to see, and it's really what I expected. Monday at the open, it was a little scary with that huge VIX spike because that could have potentially told a different story than what was out there. But this bounce and recovery off of Monday, we've filled the gap. We're close to trading where we were at Friday at the close.
Yeah, which was still massively down. So it seems that we will. Well, actually, no, we might not have a down week. Oh my gosh, I just thought that, oh, yeah, we'll have a down week. But look at this. I mean, right now
Yeah,
for the week, only down half a percentage point. I mean, this
exactly.
could turn around.
Exactly. And this is where there there were multiple events over the last week from the um, you know sell off in mega caps and money going into other areas to the Fed and maybe some investors saying that the Fed should have cut rates, but that was never the expectation. The market was always pricing in a cut in September, so that wasn't too much of a surprise. It seemed like after the fact, traders were saying, oh, shoot, we should have because of that jobs report. But it does seem like after this initial shock, that the investors and analysts are saying, stay the course, right? And this is where I saw UBS. They shared a letter saying that despite some weaker than expected economic data in recent weeks, market volatility sparking fears of a recession, the U.S. economy is still on pace for a soft landing. Corporate profit margins remain strong, and consumer spending is normalizing from high levels, not deteriorating. And I think that that's the big thing here. It's sure there might be some data, but big picture, things are still on track and going as expected.
Yeah, but we just see that, as said, it was just a combination of things, right? So we had the tech sell off, we had the jobs report, the so called SAM rule was triggered that supposedly has predicted every single recession since 1953 or 1954 or something like this. Then we had the carry trade where the Bank of Japan raised interest rates, and this made actually the yen. Let's just go to the Japanese yen versus the U.S. dollar, and we see that the yen was just spiking higher here after moving lower for such a long time. I mean, we might have to switch to a weekly chart, but you see how the yen just lost against the dollar, especially over the past few years, and then this sharp spike. So yes, definitely several factors, and I think it helped last night. If you're taking a look at the minis and the Asian session here, that last night the Bank of Japan said, "Well, we're not planning to raise interest rates until we see markets normalizing." So this kind of took one of the elements off the table. And the tech sell off, I mean, this is something, the rotation, that is absolutely normal. So now we have kind of two factors taking out of this trifecta. And this is where today it's definitely back to normal.
Yeah, and these recession indicators, I think at times can be a little bit tricky to interpret because investors want a reason to to panic when they see the markets down, right? There's this drop, and then there's this, trading psychology and mentality. Oh no, I need to take my money out of the market because it's going to get worse. And even if at some point there's a recession or a soft land, whatever you want to the end result to be, it's this bigger process, right? It doesn't happen in a day. It doesn't happen in a week. And I remember when we first had the inverted yield curve, everybody was freaking out and saying, hey, we're going into a big recession. And the markets made record highs. In fact, that yield curve inversion is the longest it's ever been between the 2-year and 10-year yield.
Right. And I'm bringing it up here because right now we are getting very close to the zero level again, where maybe we're dodging a recession. But I mean, it's if you look at the Fed funds futures traders, and there is still right now a 65% probability priced into a 0.5 percentage, 0.5% cover, so 50 basis points versus 25 for the September meeting. But I mean, we have seen this as high as 85% over the last few days. So that's also calming down.
Yeah, and we also have found that through this whole rate hiking campaign and the potential for a drop, Fed funds futures have been overly optimistic. So yeah, I think a quarter point's on the table unless the Fed has some data that is very alarming.
Yeah. We also see that the VIX spike seems to be over. I mean, the VIX spiked up to 65. Right now, we're back to 22. I mean, still at elevated levels compared to where we have been pretty much the whole year. I mean, the whole year we managed to tip above 20 just once. But I mean, levels between 17, 18, 19, and 20 are kind of normal. And right now, we're coming back to a level of 20. I mean, the levels that we had in the fear index here that were somewhere between 12 and 15. I mean, this was unsustainably low. So I kind of like it that we're getting back to normal, because if you're looking back over the previous years, we see that, okay, typically we are anywhere between 15 and 20, that this is kind of normal. And that's what we are looking for.
Exactly. I mean, the 200-day average is 14.4, and if we go back 10 years, it's 18.21 essentially. So I like that we're elevated, and I would love to see the VIX stay in a 15-20 range rather than that 12, 15 range that it's been in for a majority of the year.
Yeah. By the way, looking at the VIX spikes, I found this very interesting tweet this morning, which I thought was hilarious. So, because according to the VIX, the worst market events of our lives were the 2008 financial crisis, COVID, and the Bank of Japan raising interest rates by a quarter percentage point. Because it's like, and
I mean,
I mean, Douglas, you do have a point.
And that's why there were so many scratching their heads Monday morning when an hour before the markets open, the VIX was spiking like it was 2008 again.
Yeah. Looking at what's happening right now. So we're looking at the earnings calendar, and this is for this week. We had a few companies reporting earnings here. So we will take a look at Disney yesterday after the bell. We had Airbnb reporting earnings. We also had Emerson Electric. We'll talk about this. It's about the position that we are in. We also had Lyft reporting earnings. So let's take a look at some of these. And I think the most notable one is probably Disney.
Yeah. Disney. So Disney actually reporting great earnings. You had EPS beat, also better than expected revenue. But we see that Disney is down 1.3%, coming off of session low, so rebounding a little bit. But the real concern here comes from Disney's park numbers, because their theme park business was a little bit of a weight on the stock, saying that there was lower consumer demand and inflation that hurt those numbers. But then that's where Disney is a brand. Of course, there's the theme parks as we know them, but they're also a media company, right? So I think that's why we're coming off of these lows here.
Yeah, and so do you know actually how much of the revenue is or profits is still generated from the theme parks across the world?
I do not. I do
Yeah, me
not.
neither. I was just curious. We should look it up for tomorrow. Might be interesting to discuss because they definitely, as you said, have morphed into a media and streaming company, right? We know that they acquire different studios, that now they have these box hits, and they have Disney Plus together bundled with Hulu and ESPN. And actually, they said, hey, our streaming service does really, really well. In fact, we're doing so well that we are thinking about raising prices by $1 to $2 per month, which is great, right? I mean, because this would drop straight to the bottom line by raising prices here. So that's good if they could sustain. Because I'm wondering really, how much do they do in revenue? Is this the parks really significant, or is this where at a point where they say, you know what, whether we have the parks or not, I mean, this is just great. And we're making most of our money with media, and that segment is growing. So we are becoming less and less dependent on parks. Would be just interesting. It seems that this morning, as you said, they're bouncing back nicely. If you look at a 5-minute chart of Disney here, it seems that this is kind of what traders and investors are seeing. Like, okay, how much are you really still dependent on theme parks? And again, might be way more than I'm thinking it is.
Yeah, that would be interesting. I did see operating income was up 19% year over year. And a lot of that had to do with their streaming business, just to prove your point.
Yeah. Airbnb reporting earnings and investors not liking what they hear, even though they're coming off the lows, but still down 12% after kind of flatlining in the revenue and showing less of a profit. And I think for Airbnb, it's all about the guidance.
Yeah, Airbnb is a tricky one. And they did show weaker revenue guidance for the third quarter. So, like you said, that's a big driver here for this move lower, because they beat on revenue. They had weaker earnings per share, but it was that third quarter revenue guidance that probably really drove this lower.
Yeah. Same like Lyft. I mean, Lyft for them, it was also just about the guidance going forward that is driving them down because they did beat both on earnings and revenue, but still down 12% based on the guidance.
Yeah, and this is it's pretty nasty, and that's why it's down almost 12%, because they issued weaker third quarter revenue guidance, and they said they see it between 90 million and 95 million, but analysts were expecting 103 million plus.
Right.
So analysts not liking that, and that's a big change compared to what we saw with Uber, which you would think would be in a similar situation.
Yeah. Uber yesterday reporting earnings yesterday, already up, what, 10%, I believe it was yesterday. Yeah. 10.93% today, adding on another 5% as they see their big rival Lyft stumbling here. So, yeah, tale of two companies. I mean, Uber started first, then Lyft came up as competitor, but I think that Lyft missed the dramatic shift that has been happening in the rideshare, and Uber has been able to capture this with Uber Eats, right? I mean, kind of competitor to DoorDash, Uber deliveries. I mean, Uber Cargo, Uber car rentals. I mean, it's just crazy what they're offering these days.
Yeah.
All right, let's take a look at our positions here and see what is happening. And on the WTF scanner, no new positions for today, no exits, but we do have 8 positions that we are in. And first up here, AXP, American Express, pulling back a little bit from the highs today, but still up nicely, a percent, nicely trading above our entry. We entered at 226.96 and right now trading at 233.30. So this is working out nicely.
Doing what we want to see.
Capital One financing, very, very similar, nicely trading above our entry, entered at 131.94, trading at 135 right now. Also coming off the highs, but gapping higher today. At first pushing higher, right now trading around the open, but definitely nicely moving higher. Now, EMR, on the other hand, EMR reported earnings today. And traders and investors didn't necessarily like what they see, but then we had a recovery and now coming back. What's happening here, Mark?
Yeah, so the earnings dipped there. They had better earnings per share, but weaker revenue. And I mean, this is where with the WTF strategy, you could always close a trade early to avoid that earnings risk. And this is where, from a strategy perspective, we have taken signals without concern for earnings. So I held this into earnings. And on that pullback, I did buy more shares at 101.48. So a bit lower from the original entry, but on the ad, I was able to pick up some shares right at the low of
Nice.
the day. Look at that.
Yeah, that worked out nice. All right. So we'll see what happens there. And then we have GM. GM moving higher today, up 1.7%, moving towards our entry. We entered at 42, and then right now trading at 41.30, a dollar below our entry.
Yeah. I mean, this was another one where the ad worked out nicely because I picked up some extra shares at 39.40 on Monday, right at the open. And so far, that looks like perfect timing.
Yeah. Google up today another 1.5%, nicely trading above our entry signal.
Yes. Loving that.
Honeywell finally moving above our entry signal. Honeywell was really a super interesting one because when the markets were crashing, it held up really. And then yesterday, when the markets were recovering, Honeywell was down. And we thought, what the heck? But today, up 2.4%, nicely trading above our entry signal. So we'll see what happens there tomorrow.
Yeah, with today's move higher, positive, and might have an exit on this.
Yeah, MET, MedLife, also entered at 68.91 and right now trading at 69.90. So nicely above our entry signal. Loving this one. And then I believe the trade of the year. TTD, the trade desk.
Yeah, we will have to see, but I got filled at 77.32 right at the open on Monday. It traded as low as 77.11 on that day. Now it's up almost $10 and not even 3 completed trading days, and we'll see. Might have an exit for the open tomorrow. There is earnings on this one, and I think TTD reports earnings after the bell. So we'll see.
Yeah, and this were really a 13% move with earnings, maybe pushing it higher. It could be the trade of the year. So we'll see on this one. So these are the positions that we're in with the WTF strategy. Again, nothing for us to do. I believe that tomorrow we might see a few exits.
Yeah, it looks like it.
All right, hopping over to the wheel and looking at our wheel positions. First up, CSIQ, and CSIQ today started off strong, pulling back a little bit, still up 1%. So we'll see. Nicely trading above the 14 line, finding some support there, but we definitely need this to move nicely higher here. But nothing for us to do on this one. Halliburton. So very similar. Today started off strong, pulling back a little bit. We got a sign at 34.50, right now trading at 31.15. So what, around 10% below our entry price. Nothing for us to do just now. Colts, similar. I mean, this were, I got a sign at 21.50. You didn't trade this one. Opened higher this morning, opened at 20.36, and right now trading at 20.12. So a little bit down. Have not been able to sell calls just yet against my existing 50, but might be able to do that tomorrow if we see another push higher. All right, Merck down again today, and I mean also having a good start right now, pushing a little bit lower. I'm a little bit surprised, I must say, that Merck is not pulling back down for the day, only 0.1%, but still down for the day while the markets are overall up. I mean, come on, Merck, pull higher here. I mean, we need to see. Right now, my break even is at 116, but the current price is at 110. So definitely need this to move a little bit higher again. Now, before we go to UPS, Mark, you also have open puts that you sold on BP.
Yes, sold the 34.50 expiring this Friday. Now on Friday it does go ex dividend, so not likely to have an early assignment because someone would be giving me those shares right before getting the dividend. So we'll see where we end up Friday at the close, but it looks like I'll probably be assigned and then look to sell calls on Monday. So still have this one open.
Yeah, and then AVGO, Broadcom. I mean, this is one that you also traded last week where you sold, which one? The 125 puts, right?
Yep. Yeah, so last Friday when things were dropping, I love this opportunity to sell the 125. It was reminiscent of the pandemic where you had this great volatility and we were able to sell puts 10% plus below the market. So I took advantage of that. On Monday, there was that huge volatility explosion, and but it has recovered. And today I was able to buy those puts back at 94% of max profit. So I have another open position to consider now.
All right, fantastic. And then finally, for both of us, UPS. And today, UPS finally up again at 152 and still trading in this range between 124 and 132. So come on, UPS. Time for you to move, make another move, breaking above the range of 132, filling the gap, and then keep marching higher. But nothing for us to do just now.
That's correct.
Alrighty, now we'll take a look at where the markets are right now, if we are still trading at transition highs, if we are recovering or not. But before we do this first, it is the time of the day for our dad jokes. So what do you have today, Mark? Do you have a dad joke or do you have a bar joke?
I have a double dad joke. I mean, this is as dad as it gets.
Oh, dear Lord. Let's hear it.
What do you call a baby birch tree?
A baby birch tree? I don't know.
A son of a birch.
Okay.
Like I said, it's a double dad joke. It's a real dad joke.
So way back in the days when I was still working for IBM, I was running late for work one day, and my boss called me and said, "You should have been here at 8:30." And I said, "Why? What happened at 8:30?" No. Okay.
That's a son of a birch.
Son of a birch. I'll give you this one. I mean, that's a good one. All right, let's take a look at 5-minute chart of the S&P back here, and we see that right now, well, we are trading around the open, and this is what we have seen over the past few days. The recovery, it's not yet in full swing. I mean, this were on Monday, we saw that after opening much lower, we first pushed higher, but then in the afternoon, we're moving lower. Yesterday, same. At first, we were pushing higher. Into the afternoon, moving a little bit lower. Right now, we opened higher, hanging out around the opening price of the day, which means for the S&P up 1.3%, for the Nasdaq up 1.6%, for the Russell up 0.8%, and for the Dow also 0.9%. But I'm almost expecting, based on what I saw here over the last few days, that in the afternoon we see a little bit of a sell-off, but it does seem that we might have another positive day after we snapped a 3-day losing streak yesterday.
It looks like it, Marcus. I mean, right now we're up 0.25% if we take the open. So a lot of that overnight, like you said, it seems like there's a little caution being long going into the close, and then activity overnight gets investors interested, and then we gap higher. So we'll see if that pattern repeats today.
Yeah, and with no economic news on the calendar, it really depends on what else are traders focusing on right now after the Bank of Japan said, okay, we're done raising interest rates. We first want to see what's happening here in the markets. No notable earnings. So this were, I wouldn't be surprised if we are just diddling along for a couple of days and trying to shake off what happened here last week, last Friday, and on Monday.
Agreed.
All right, with that said, you never know what happens in the market and you want to stay informed. So this is why, if you haven't just yet, hit subscribe. If you like today's video, click on like. After the show, leave a comment. Which of these 2 dad jokes you like better, the son of a birch or me being late for work? And well, if you feel that this was information worth sharing, there's a share button right underneath. Just share it wherever you want, with whomever you want. We really appreciate it. And with that said, we will see you again tomorrow morning. And until then, have a great rest of your day.
Happy trading, everybody.